Yes, today I just want to focus on the accounting 1A and then we'll take it from there. Uh, the slides which I gave you, these are my contact details. So if you want to ask maybe some questions, I know you're doing this online space, so you can contact me on this or communicate with me on this email address. It's my email address. And then at the same time, I've got some of the few videos on YouTube, so you can go and search for Sylvester. Hopefully, those videos will be useful to you at the end of the day. So you never know when do you need help. That yes. So, but yeah, at the end of the day, you just have to communicate with me, and then we can be able to help. Okay. Now let's not just waste time. This is aligned to a textbook. Uh, Firstly, as you can see, our learning unit is Introduction to Business and Bookkeeping and Accounting. So at the end of the day, I want us to understand the difference between bookkeeping and accounting, because most people don't know that these two things do differ a bit. Okay? But don't worry, at the end of the day, we'll end up understanding that. And again, there's a system that we're going to learn, which is called what? The double entry system. Okay? So if you can check in your book, they talked about the development of accounting systems. You know that accounting gradually improved throughout the years. That's why we've got this research just to better accounting, like any other subject. People are engaging themselves on research in order to make things better. Okay. So here we have got a person by the name of Luca Chioli. They say this person is not the one who introduced accounting, but is the one who tried to simplify accounting. In this book of ours, they refer to him as the father of accounting. So sometimes they ask you questions around there about who's the father of accounting. You can see. So they say Luca Procuri is the person who tried to come with the systems which made accounting a little bit better. Again, it's not someone who introduced the accounting, but he tried to come with better systems. Okay. But again, for more information, I think this can be learned from the book. You can just go through the book and you'll see the history there. Especially for the multiple choice question, the matching column questions, it can help you a lot. Okay. As you can see, it's referred to as what? Father of accounting. Some of the questions they normally say, they give you some options and they say, the father of accounting, and on the other side, they give you what? Look up a few. I think it's easy for you to remember. Okay. Okay. Just try to, just to simplify it a bit. As you can see here, father of accounting, look up a cure. Like I gave you those. These are the same slides which I gave to you. Yes, you can. It's good to. There are different ways to take pictures. Okay. So according to him, the successful business needs sufficient amount of cash. Oh, that's true. You'll see by the time when we start recording transactions, some transactions are in the form of cash, and some of them are in the form of what? Credit. Remember, we don't always have enough cash at our disposal. So sometimes we need credit for us to be able to acquire what we need. Okay, so you will see the summary of the transactions will normally be based on the cash or credit. Okay, but he said sufficient amount of cash or credit so that we can be able to sustain ourselves in this market. Okay. Through bookkeeping with details list of what? Transactions. The main aim why we have accounting or bookkeeping is because we have got list of transactions which needs to be summarized. But why are we summarizing them? It's because of the users of those information, which is what? Accounting information. You will see by the time when I show you flow in accounting, you will see that everything starts from what? Transaction. Without a transaction, there is no accounting. A transaction is a financial activity. Like for example, during break you go to the canteen, you buy cold drink. What is that? A transaction. So these transactions need to be summarized by what? By the bookkeeper, by the accountant. It means bookkeeping is very much important because we are trying to summarize the transaction. Okay. Any questions so far? And we still the theory, but we need to talk about it. Statement of cash flow statement. Remember, we normally say cash is king. If you don't have cash, sometimes you think like the whole world knows that you don't have cash. You know that without cash you cannot move around. You couldn't come to school, you sit down. So cash is king. So that's why sometimes when we compile books of account, remember in accounting, we don't care whether something is cash or credit. We record them. Okay? So the profit that we made doesn't mean that we made cash. Let's say, for example, we've got a profit of 1 million. It doesn't mean that that 1 million is cash. No? Meaning part of it is cash and part of it is still to be received. Because it has got transactions of a cash nature and transaction of what? Of a credit nature. So a cash flow statement helps us to identify only cash so that we can be able to commit ourselves. You cannot commit yourself in situations because you are going to receive cash in 6 months. That 6 months cash is not guaranteed. What do? You just compile a statement of cash flow and you know exactly how much you have as cash at your disposal. Does this make sense? Yes. Okay, again, I think here I should have said and. Just if you understand, it must be and here. I think this is just a typo. This must be the statement of cash flow and statement of changes in equity. Okay. So this must be the statement. There are two different statements. I just missed and. Just insert and for me then. Okay. Now, we also need to compile a statement called statement of changes in equity. In simple terms, statement of changes in equity is the same as the statement in changes in capital. Equity represents capital. And capital is the business wealth, the owner's wealth. Okay? So at the end of the day, we need to check the changes around capital. If I may ask you, what is capital? According to your own understanding.
Well, originally it was like money that gets put into the business to create other money, but now in economics we found out that it's also like machinery, equipment.
That's true. It's not all about money. It's not all about the money that you use to start the business with. It's all about other items, other things that you can start the business with. Even though you started the business, sometimes as the owner you contribute to those assets like equipment that you said. Any contributions by the owner to his business will be classified as what? As equity. Okay. So this is very much important. Any questions so far? Now, remember this system, like I said, we have a system called double entry system. Sometimes you call it double entry accounting. You can see on the first slide, I wrote double accounting system. So it's the same as the double entry system. Remember, as I said, it's all about what? Transactions. And those transactions must be summarized. So in accounting, we have got two sides. We have got what? Debit and credit. You will see by the time when we compile the general ledger account, the account equation, when we read transactions, we always identify two accounts. So if you bought equipment on credit, the two accounts are equipment and creditors. Okay, listen now. So you must always have at least what? Two accounts. So the other account must be debited, and the other account must be, what is that system? In accounting, when you see yourself debiting one account and crediting and debiting the other account, it means you made a mistake. You debit one account, you create the other account. That system is what? For any debit entry, there must be a corresponding credit. But again, this will be put into place. For example, we're going to calculate and this will make sense. But for now, we're just looking at the theoretical background of this particular system. So this system is very much important. Okay. Again, for more information, you can just go and check the book. Even here, I think this slide is very detailed. May I continue? Yes. Again, just put it like in a simple way. As I said, this is what we're going to open soon. Account name, we call this general ledger account. Okay. So an account is going to debit a credit. So again, you are allowed to put DR. Don't mistake this with the doctor. This is the debit. And this is what? So you will see, again, as I said, we always identify at least two accounts. Each account will have debit and credit. So if I debit one account, it means the other account must be, that system is called what? Double entry accounting or double entry system. It's the same thing. Okay? Remember this one. Okay.
debit's always on the left.
The debit will always on the left, and the credit will always be on the right. It will never change. You see? So make sure that you know how that account. But again, it makes sense when you start recording. And then we need this foundation. Okay? Now, in accounting, we have got 5 groups of accounts. Sometimes we call them categories of accounts. Sometimes we call them elements of financial statements. Okay, so it doesn't matter. But the fact is, every account that you identify must fall within these groups. You will see, especially for account equation, when we deal with account equation, we always try to know the accounts according to what? To the groups. Yes, some groups have been divided into 2. For example, assets have been divided into 2. Namely, try please, if you remember very well.
Financial, I don't know.
It's okay, it's a lesson. So assets have been divided into 2, namely non-current assets and current assets. I repeat, non-current assets and current assets. But what is the meaning of the non-current assets? This means long-term assets. So long-term assets are classified as what? Non-current assets. Again, they are usually referred to as fixed assets in those days. Again, sometimes they call them what? Tangible assets. So assets are divided into 2. But don't worry, still, I'm gonna break down these assets for you. But I'm just telling you in advance, okay? So that you cannot be surprised. So I want you to feel bored when you see them. It means you understand. Okay? The same applies to what? The liabilities. Remember, assets is what you own. It's what belongs to you. Your handbag is your asset. You've got the private ownership. Your shoes are your assets. Your car is your asset because you've got the ownership. You've got the rights towards that particular asset that exists. Okay? So meaning an asset is what is your belonging, your possession at the end of the day. Like I said they're divided into what? 2, namely current and non-current. Okay, it's a process. Now let's come to the liabilities. Liabilities are what you owe. That's why sometimes some friends classify us as liability. You know, it's not a good thing. Because when you say I am your liability, it means I'm unfavorable to your situation or to your space. So, unlike you call me, hey, you are really an asset. Think about when they call me and say, Sylvester, you are really an asset for this business. I'll feel good. But if they say you are a liability, I tend to feel, no. Why do you call me that? That is negative, okay? So at the end of the day, again, liabilities have been divided into 2. Namely, non-current liabilities and current liabilities. Remember, non-current liability means long-term liability. Things like mortgage loans. When we buy houses, we use loans or bonds. So those are the long-term assets. And sometimes you can have a loan for 5 years. What is it? Long-term assets. But now sometimes they for what? Current liabilities, short-term. Like short-term loan for 6 months. You see that? And then again, maybe you can buy goods on credit. The creditors are your liabilities, which are current. Sometimes some of us have got access to the funds which do not belong to us, the bank overdraft. The bank overdraft is what? Is it current? But again, I gave you examples, so we're going to go through them. Okay. Are you okay with the assets and the liabilities so far? Now, equity. You can slash capital. I said, equity is the owner's interest in his business. I repeat, it is the owner's interest in his business. It's the financial interest that we have in the business. That's why sometimes if you follow the news, especially with the government, they normally say you need to disclose your financial interest. Meaning you have invested equity in one of the businesses. So by having an interest, meaning you expect something in return in the form of dividends. They must share a profit with you. So at the end of the day, equity is what we invested into the business. Like you said, it cannot only be what? Money. It can be a building, Let's say you and I want to start a business at the moment, and we've got 1 million, I've got nothing, but I do have premises. My premises will be regarded as the capital contributed towards that particular business. It will form part of what? Of the equity. Which is that. So, but we don't have, it's not divided. Okay. So we only just have what? We've got one equity. Sometimes you can just say owner's equity. You can even write it and say owner's equity. So suppose if I say equity, I mean what? Owner's equity. Why are we in business? You can think about a school like this. Why are we in business? It is because we are striving for incomes. And these incomes are not guaranteed. That's why the finance department of a particular company need to work together so that at the end of the day, they can generate more incomes. Incomes are the same as the revenues. Like a school. What is the main source of revenue of that particular school's revenue? Is the school fees. So it depends what is your main service. Okay, a medical doctor, they charge you a fee. That fee will be regarded as what? You can have the main incomes and the other incomes. Because sometimes you can find that, let's talk about the school. The main income is the school fees. But sometimes you can rent out the venues to other companies. That rent income is the other income. So our main aim is to increase the income so that we can end up making what? Profit. But unfortunately, in the process of generating those incomes, you cannot avoid what? Expenses. It's like you today, I think already there's that expense that you get already again. So unfortunately, the expenses are there. That's why we try to minimize expenses and maximize what? Incomes. Why? Because the difference between the incomes and the expenses will either give us profit or loss. So if our incomes are more than the expenses, this means that we made profit. But if our expenses are more than the income, it means we made what? Losses. That's why companies are making sure that they minimize the cost. Even though sometimes it's not easy, but some companies resort to retrenchment, for example. Think about the mining sector now. They say they're gonna retrench about 6,000 employees because they are thinking about the shareholder. They want to maximize shareholders' wealth. At the same time, they need to satisfy South African labor, environment. So how do you balance it? Do you think about the employees or do you think about the shareholders? Because if you don't think about the shareholders, they will take the investment somewhere else. If you don't think about the employees, they will be irritated. That's why sometimes they go for strike. So unfortunately, it's not easy. But let's try to increase what? Incomes. So these are the groups which we need to know. Yes, we need to know the groups as groups. At the same time, we need to know what falls in that group. For example, if I say, what is this laptop to me? What am I it for? What can I say?
I don't know if that's long term or current.
For you to understand them better, the non-current assets normally are the ones that are used to generate what? Income. You don't sell them, you don't convert them. No, it's an asset, I agree with you. But you said you don't know whether it's current or non-current. Normally, the non-current assets are there for a longer time. Like a building, you use it to generate what? Income. But the bank, the money in the bank is not what? Long term. Why? Because it changes within a short space of what? Of time. But again, don't worry, you're gonna get used to them when you use them. Any questions so far? No. Now, the challenge is yes, we can know the accounts, but for recording purposes, each and every group has got its own rules. Remember when I just started here, I talked about the two sides in accounting. Name them. Debit and some groups increase on the debit side. Some groups increase on the credit side. The minute you say a group increase on the debit side, it means it automatically decreases where? On the credit side. Yes, there are various ways of learning the rules. Some people prefer to just sing singing the rules. People have got some system with what I call the dead click. But because I went through the other systems and I made some comparisons, I just came up with my own system where I usually call the box method. Can you see? So I just said, okay, let me group those categories according to the behavior. Meaning everything in this group behaves the same. Unlike if I read rules on assets only, it means I'm memorizing. So what I need to remember, I just remember and say, okay, in this box, we put assets, expenses, and what? Drawings. So they all behave the same. They all increase under which side? They all decrease under which side? Can you see? I'm about to finish now. Unlike if I learn them one by one. So when I write exam, before I start writing exam, I can draw this box down and put some arrows. So that by the time when I record, I keep referring to the box. You will see when we deal with the account equation, it's going to be very easy when it comes to this box. And you don't have to memorize them, we just have to know the box. Remember what is inside the box. Remember the arrows as you can see. The assets, expenses, and drawings increase on the debit side, but they decrease on the credit side. Yes, there are other systems. Even your book shows you where they have for the T account with the plus minus there, plus minus there. Yes, it depends on the individual. But for me, it worked very well. This worked very well for my students because they just have to have a box and check their groups. The other groups will be grouped together. It's the opposite of the first group. I've got capital, I've got liabilities, I've got what? They all behave the same. They all increase on them and they decrease on the debit side. So again, you can write these boxes before you start your assessment. They can help you a lot. Any questions so far? So far, so good. No problem. Now, remember when I started, I said, why do we compile accounting books? Why do we have accounting? And I mentioned something like a transaction. Yeah, so that's why we've got bookkeepers, we've got accountants who make sure that they summarize those transactions. But you cannot just summarize transactions for fun. There's a reason for that. It's for what? The users. So the user of financial information. Remember at the end, those transactions will be converted. That's why there's something called financial statement. Sometimes we call them financial reports. Meaning everything starts from what? Transactions. And they end up producing what? Financial reports for users. So that these users can use them to make decisions about their future. That's why sometimes we involve auditors. Because the users need to rely on the information. With the assurance by the auditors, we as the users tend to believe that the books have been fairly presented without any misstatements. They are not biased. Can you see? I think you know sometimes people try to manipulate books. You always following the news, eh? So they understate expenses, they overstate expenses because that gives them as an incentive to get bonuses. Think about when they say if you make 1 million profit, you will get an incentive bonus. And you don't reach it, I'm telling you, you can manipulate books and say, okay, according to our book, this is 1 million. Can you see there's a risk of misstatement there at the financial statement level? So at the end of the day, these users need to be satisfied. So we compile accounting because of the users. The users, all of them are called what? Stakeholders. Because they've got a stake in our business. I respect my customers. Why? Because without them, there is no business. So they have got a stake in my business. I consider my customers as my investors. So all of the stakeholders, they can either be internal or but what is a user? A user is someone who is interested in my books. You don't have to be the owner to become a user. As long as you are interested, it means you are what? A user. You are here at school. You know that you are the user in this school. Because whatever happened to this school affects you. You are interested in vertical schools. Why? Because you invested your time. You invested your money. Anything that happens to it affects your training. So you are the user. But if I can take the financial reports for this school and go to downtown Johannesburg, take one of the taxi rank and I distribute the report, what do you expect them to do? They'll just, what is this? They put them in the dustbin. Because they are not interested. They are not what? Users. Users are those people who are interested in my books. They can either be internal or internal, for example, managers, the board of directors, employees, and the users. Why? Why am I saying I'm the user? Because I need to know if the business is doing very well, otherwise I won't be paid my salary. I'm thinking about my benefits, my pension, everything like that. So that's why I'm interested in the books of my employer so that I can feel secure. The minute I feel unsecured, it will mean that I will need to seek better ways of what? Of protecting my future. So at the end of the day, I am the internal user. External users are suppliers, banks, investors are internal in a way. SaaS. You know, SaaS is interested, you know what? They want to share something, they want something from you. Can see that? So it means this you need to know that there are two different types of users. But both are called stakeholders. But can be divided into two. Okay. Any question? I'll give you a break there after this. Okay.
Don't worry, I thought I'm copy, I was interrupting.
No, it's okay. It's okay. Now, here I just try to give examples of the users. As you know, there are many, and I try to explain why are they interested, things like that. We've got investors, as you said, they need information about the profitability. It's all about the dividends yield. You know that. So you remember, if I am the investor, I'm interested in the return that you're gonna give me. So by the dividend, the yield is like the return to what? To the investors. Okay. So they want to know about the price earnings. You know that the price earnings is based on the earnings which we make per share. For example, earnings are the same as profits, don't be confused. So if the earnings and the price earnings per share are higher, that will attract more shareholders to come and invest in our company. Okay. Again, the lenders, you know that people who lend us money, obviously, they will need to be repaid back. Okay? They need to be paid back their loans together with what? The interest. That's why sometimes these business people can take you to court and apply for what we call the sequestration. They say, no, this person, according to the financial position, won't be able to survive. He lacks a going concern. So they can just say, okay, let's liquidate because we need to what? To get our money back. Especially those who are secured. Like you used your house to as a security. They know that they're the first people to be given money. So they can take you to court. Okay. Management, that's obvious. Why? Because they need to make decisions, they need to make decisions about the planning, the policy making, the evaluations. Management is very much important. Like financial managers, they need to make investment decisions, they need to make operational decisions, they need to make finance decisions. How are we gonna finance the business? But they need to see what? Financial statements first. They are what? The users. Okay. Suppliers, as you said, and the creditors, same. The government, the state, about the various statistics. That's why sometimes these people come and count, they count us, South African. They are, even for the companies, they do the same. They want the statistics about the GDP, information so that they can be able to make decisions. Remember, even the government is all about policy making. You see, the fiscal policies, everything like that. So the government again needs the information about the business so that they can form what we call the economy what? Okay. Customers. Most people don't take customers seriously. Sometimes when I go and buy something and I can see that someone is making a customer service, I'm just looking at them and saying, these people, I think they're spoiled. Huh? You know that I've got options, but how do you treat customers like that? It's like they're doing you a favor. No, for me, a customer is a stakeholder, as I said. They've got a stake in my business. They invested in my business. Without them, I nothing. So customers are also the users of what? Of financial information. Because I have that relationship with them. They are interested in my business. They want to know what is happening to my business. Okay?
But that's only for companies that are on the stock exchange. You can't. How does the customer ask for the financial statement?
No, they're not asking, they're interested.
Okay.
Remember, some companies can make them public. So if you make them public, they will be interested to it. It's not like they are entitled. They are not entitled. They are interested. If you give them financial statements, they won't mind. Okay? Employees, like I said, the stability of the business because you know thinking about the employment, am I secure enough? The benefits, the promotions, things like that. That's why you are the user because you are interested. You don't have to own anything. Okay, the public at large, they want to know more about the trends and the recent developments. Sometimes we associate ourselves with some other companies. Maybe they did something good to us. Think about the companies which offer bursaries. Yeah, obviously, you will need to know whether they've got good financial information so that they can survive, so that they can help more people in the future. You see now? So even the public at large is what? One of the users. So we do have many users. Like as I said, SARS, SARS is like part of the government. You see things like that. So they can ask you to name them or give you one of the users and say, why do you think they're interested? What do they need? In your own ways, you must just think about, okay, they need to make decisions about this and this and this. Okay. The uses of accounting information, like those people that I've been talking about, if you want to know why are they using that information, you can just replace what I just explained. You can refer to these pages. They just tell you that this person maybe wants to make this decision about this information. Okay, so I'm just not going to waste time on this because it's very easy to understand in that section. You can just go and read, but if it doesn't make sense, you just have to. You have got my details now. Yeah. Yes, and then we can just continue. Okay. The development in accounting field. Accounting is like any other field. There are always developments, the evolution of accounting. Yes, in those days they never had accounting. According to the little I know, they say they used to record information, but they used to use rocks to write information. That's why most researchers get information about the past using those rocks. Okay. So because of things change, there's a development in accounting. That's why nowadays we've got computerized accounting systems. We've got the pastel accounting, the QuickBooks, spreadsheet. We've got a lot because of the evolution, the development. And again, now accounting is uniform. I can go to UK, lecture them accounting like what I'm doing now. Why? Because we're following the same standards. So that's why this came up with what we call the gap. This gap called Generally Accepted Accounting Standard. These were the local standards of particular countries. For example, in South Africa, we've got our own gap. If you go to USA, there's a US gap. Can you see that? So these were local standards which tried to ensure uniformity amongst the participants in this accounting environment. So they try to say, what? We need to follow one thing. That's why if you don't follow it, maybe when the waiters come, they say, no, you need to make sure that you follow that particular standard. So these were local standards. But they do not exist anymore because they've been incorporated in what? IFRS, International Financial Reporting Standard. Meaning everyone across the globe need to use what? IFRS. Gone are those days where we only use GAAP for what? For a particular country. So now we follow what? The same standard. That's why you can go to UK, you can go to Zimbabwe, you can go to Kenya and practice the same accounting because we are all guided by what? IFRS, which at the same time we use this with the International Accounting Standard. We also have what we call the IAS. You will see when you progress with accounting, you will start using the standard to compare books. Okay, but again, we are here now. We've got the IFRS 3, we've got 2, we've got 16 things like that. So we've got 10 for consolidations, things like that. So at the end of the day, accounting has been what? Standardized. But for more information, you can refer to 86 to 10. Okay. Any question you elaborate?
No.
No. Now, internal versus external reporting. Remember we talked about the users. Some users are internal, others are yes, so this is external. So when we report, we need to check which reports are suitable for external users and which reports are suitable for what? For internal users. As you can see here, we've got what we call the management accounts. Here we've got what? External what? Reporting. Normally, external reporting is associated with financial accounting. You can write financial accounting next to it. I'll explain better. Financial accounting. Now, if you check here, the financial accounting has got a framework within which we work. We are following standards. We follow IFRS, like the one that I just mentioned, International Financial Reporting Standard. We follow the IAS, which is what? International Accounting what? Standard. You will see, as I said, when you progress with accounting, you will start using this standard. Okay? We need to know more about the International Financial Reporting Interpretation Committee. Remember, when they come with these standards must be interpreted for fairness. There must be a committee which oversees the whole interpretation process. Okay? We call it International Financial Reporting Interpretation Committee. We also have the Standing Interpretation what? Committee. These committees are involved in this development of what? Of accounting standards. Remember, standards are like laws. People just come with them. It's not like they are perfect. That's why they try to improve each and every time. They come with a new standard. They remove it, like we put the standard under leases. Can you see now? Now they change them. Can you see now? So again, it's all about this committee. They are involved. Okay. And again, as I said, there's a framework within which we must work. So according to accounting, we need to follow a particular financial accounting framework. And even under auditing, before the auditor audits, they must make sure that the books have been prepared according to an accepted financial reporting framework. Okay, so again, this is just the theory. We can even check from the book. Don't have to stress much on this, just highlighting it. Okay. This is the financial accounting, the external reporting. What about the management accounts? As the name suggests, management is internal. So management will use the reports to make what? Decisions about the future. If the management decides to increase my salary by 10%, meaning they're having reports in their head, and say, okay, we can manage to accommodate this increment. But normally, management are interested in the budgets. Yes, they budget for the future. Sometimes for different types of budgets. We can have zero-based budgets. We can have what we call the incremental budget. It depends. So they can say, okay, this year, okay, we can see we made this much, and then they can budget for the future. So the management needs to compile budgets. But again, those budgets are sometimes based on the financial reporting, which is financial accounting. So the financial accounting can give us an idea of how much can we invest for the, let's say, plan for what? For the future. And again, they normally budget around sales. You see that? They are considering the expenses, debtors, and what? Creditors. Because they need to make a decision. And again, the cash flow is very much important to them. Cash is key. For you to expand and have another branch as a businesswoman, you can't rely on the profit. Let's say you made a profit of 1 billion. You can't base your decision on 1 billion to go and have another branch. Remember, accounting is accrual. It means whatever you see as profit doesn't mean that it's automatically what? Cash. We don't deal with cash accounting. In accounting, we record both cash and non-cash. So when you make that profit, make sure that you identify how much is cash in that profit. That's why cash flow is important. I'm telling you, cash is king, as I said. Without cash, you can't survive. So again, management make decisions looking at what? The cash flow. And again, the other thing that is important is capital expenditure. I think sometimes at work when you try to buy laptops, you want to buy maybe tables, there's a form that you fill. It's called, normally we call it CAPEX form. CAPEX come from what? Capital expenditure. Is where we buy non-current assets. Things like the vehicles. You see, laptops, computers, the PCs. So again, the management is interested in the capital what? Expenditure. Because we invest in them. Think about this building. This building is generating more income. Because the management invested in this building. So it's a capital expenditure because it has got huge returns. So capital expenditure is something that the management needs to make decision on. That's why we call this management account. Sometimes we call them management packs. It depends on the company. So management accounting is all about making what? Decisions. Financial accounting is all about compiling those reports so that management accounting can make what? That's why in the next slide you will see I will be giving you the difference between the management accounting and what? Financial accounting. Here I'm trying to differentiate between the reporting. You see, for internal, for both internal and what? And external. Okay. Any question? Now, there are things called the qualitative characteristics according to the IFRS. We need to have this fundamental principle for us to be able to understand accounting better. And the usefulness of accounting is based on this. The accounting must be understandable. Because sometimes you compare books, you give those books to people who cannot even understand. What's the use of doing that? That's why sometimes we further interpret them to make them better. Look at your users, simplify them. That's why the financial statements have got notes. Because we're trying to further interpret. Sometimes we calculate what we call the ratios. For example, when we report on the profit, we say we can make 50% profit. Can you see now? We're trying to further interpret. We're trying to make it what? Understandable by the user. Because users have got different levels of understanding. As an accountant, simplify it. For example, sometimes I try to do this bookkeeping bookkeeping for small businesses, even for schools. Sometimes when you go and report to the school committee, you can't use the language that you normally use to other, let's say audience. You need to make sure that whatever you are saying is understandable. There are various ways of making your report easy to understand. So this is a fundamental principle, understandability. Are we together so far? Now, the next one is relevance. Why do we compile financial reports? It's because we are compiling them for the users. The information must be relevant to the user at that point in time. That's why relevance goes with the materiality. At the same time goes with what? Time. So the information must be useful at that point in time. If I need to make a decision in that point in time, it means the information must be timeless. It must satisfy that particular intent. But the question is, what is materiality? In a nutshell, it depends from which perspective are you talking about materiality. Yes, in accounting and auditing, we normally interchange this materiality as an explanation. We've got the planning, when you deal with auditing, we've got the planning materiality, we've got the performance materiality. Okay. But what does this mean? It comes from the word material. When we say the information is material, it means that information changes your economic decision. For example, when you came to school today, maybe you thought of, maybe I can go somewhere. And let's say you wanted to go somewhere and then someone mentioned the fact that Sylvester is going to have a lesson here. Because of that information, you change your initial plan. You come to school. Meaning the information was what? Material. Because it changed your economic decision. Remember, economics is all about making choices. You do economics. So if you make a choice, it means it's because of some material. Something made you to decide otherwise. This information can be material if it affects the economic decision of what? Of the user. That's why we need auditors to come and audit. Because we are sure that when you make decision, the information is free from what? Material misstatement. So meaning you can rely on it. So we need to check the materiality, especially when it comes to what? To financial statements. Because the errors and omissions can be material to what? To our decision making. Yes, and they can be material to the financial statements. Because they can be misstated due to fraud, things like that. So the material means something that can affect you otherwise. The reliability. What do you mean by saying that? Obviously, the information that you produce as an accountant needs to be reliable by the users. How can I assure them? I can make sure that I've got my internal auditors, if I can manage to pay them, so that we can say, okay, the information is free from bias. Can you see now? Because if the information is biased, it means at the end of the day, it will affect the economic decision of what? Of the user. And the information is not what? Reliable. It must be reliable to make what? Decision. But how can you make it reliable? You need to be trustworthy. So if people don't trust your information, what do you expect? No, they won't even use it. It is useless. So you need to make sure that they believe in that information. Meaning information is what? Accounting information must be comparable. Meaning I must be able to compare year one and year two to check for any trends. I must be able to compare industry one, industry two. I must be able to compare the companies in the same industry. Like Sylvester College, University College. I can compare them by looking at what I can compare the things. It is easy because you can even check if you are not doing well or not. So the information must be easily used to compare different companies. Even here, it can either be time series or cross-sectional, it doesn't matter, or you can even use them as a benchmark. Okay, so far so good. Different forms. I don't know if you did business economics before or business management.
I did business in matric.
Yeah. So I think there's a chapter which I liked a lot when I was doing my matric. It was called the forms of ownership. You just know that there are different types of business: sole trader, public company, closed corporation, things like that. Okay, they are called business forms. But remember, when you start those businesses, you always have to consider many factors. Because some of them are easy to establish, some of them are too complicated to establish. That's how we need to consider this. Firstly, legal personality. Do you understand the meaning of legal personality? What does it mean? That's true. You need to check. That's true. So because sometimes the owners are liable for the debts, they've got unlimited liability. You see? And again, you need to check whether the business can take you to, because some business can take you to court. You can be sued, they can sue you. Or you can be sued. Yes, you must check those things. Because like companies, they're considered to be a juristic person. They can take you to court. You see? The procedures, again, the procedures to operate those businesses are not the same. Even this procedure to register, it's very complicated when it comes to companies. Apply, then register the companies, you must apply for those shares. You need to check if I start a business, how are the standard procedures? Either for operations or for registration. Okay. Obtaining capital is a difficult thing. Otherwise, everyone will have what? A business. I'm telling you. Raising capital is a challenge. So we must check how do we obtain capital. Like under sole trader, you can use your own money because you start small. Partnership. Each partner can come up with something. Come up with 1 billion. Come up with a building. Can you see things like that? Under public company, you know that you can be listed at JST. You can sell shares to the public. So you must consider those things before you commit yourself with those business forms. Ownership and investment. As a sole trader, you're the single person. All the responsibilities on your shoulder. All the losses your responsibility, even though you enjoy the profit alone, but you need to check the responsibilities, the ownership, the management. Who's going to be responsible for management? Normally, under public companies, we normally appoint the board of the directors to represent us. Okay? And those directors sometimes, it's not always the case. Sometimes they think about their own gains instead of representing us as shareholders. They end up trying to benefit themselves. That's why there's something called agency problem. I appointed you to represent me, but now we have got conflict of interest. You want to enrich yourself instead of enriching the business. So those things can happen. But it's not easy. It's part of business. How do we distribute profits? Sole trader belongs to you. Partnership, we share. Companies, we distribute dividends. You see now, you must always check how will the profits be distributed if I choose this particular form of the business. Income tax, you know that some businesses are taxable. What is the current rate for companies in South Africa?
I thought the maximum is 41%. I think it's
Yeah, it's okay.
17%.
Yeah, so normally the companies are taxed at a fixed rate of 28%. I think the one that you're talking about maybe is there for individuals, where they have to be taxed according to the tables. Okay, but again, you must check which businesses are eligible to pay tax and which ones are not. Like a sole trader doesn't pay tax because the law sees the sole trader as an individual. They tax the owner as if he generated his own income in the form of salary. But companies, they need to be taxed separately as well as companies. Separate from the owners as individuals. Okay, so again, you need to share the income tax. That's why most companies are in trouble because they don't even check the income tax implications. Even celebrities, you know that some of them they don't even pay because they are freelancers. They get their gross, they forget to share with us. So after some years, they come back to you and say, "Hey, you owe me. You're surprised. You need to seek information so that you can avoid being overdue when it comes to the income tax." Those are just their considerations. Okay. There's a difference between management accounting and financial accounting. If you consider yourself a bookkeeper, an accountant, meaning you are under what? You summarize financial activities, like I'm referring to the transactions. You summarize them for what? For users. Users are the same as the stakeholders. Yes, if you're in the office and you are using those source documents like the receipts and you are recording on the system, it means you are under what? Financial account. But after compiling those information, this information normally is taken to what? So that the management accountant can compile reports for what? For decision making. Here, as you can see, management make what? Decisions. We compile accounting for management so that they can make decisions. These reports come from what? Financial. So now we must understand, we must check how do they differ. They report to outside stakeholders. Remember, you can access books of some companies online. Yeah, even ESCOM, no shading, but it's okay. It reports to outside, and this one reports to what? Internal. So here we can report to SARS, so that SARS can know how much we make. But here, what those reports that they compile, they report to the internal what? Internal what? So it's for the inside. They make decisions internally. If they decide, let's say, think about one of the mines, they want to close one of the shafts. That is an internal decision at the end of the day. The reports which they make, they use to make decisions, must come from what? Management account. Summary of the past financial events. Events are the same as transactions or activities. In accounting, we don't record something that's going to happen tomorrow. No, it happens, we record. If it happens, or it happened, it is what? The past can be the 1 minute ago. I buy first before I record. That's why we say summary of the past. But here we focus on what? That's how we use budgets. Budgets are for the future. Can you see the difference between these two? Here we look to the future, and here we look what? We use the past to compile the current. Okay? Precise, clear information. That's why we've got standards which can help us to have what? The precise information. Because if the information is not precise, it will affect the economic decision of what? Of the user. Again, here the information must be relevant and flexible. So if the management wants to make a decision now, it needs to be relevant and flexible. They need to know how to manipulate those books now, like just to rearrange the information for what? For decision making. The information must be relevant for that particular decision. We decide to close that particular segment of the business. The information that we get must be relevant to make that decision and be flexible at that point in time. Data must be summarized for the entire business. When we compile financial statements, we not only compile financial statements for operational department, we compile for the whole company. But here we deal with what we call the segment reporting. Like this school, yes, they can decide, okay, let's report on what? Let's check what is happening with IT. Only IT, not the whole business. Here's the difference. This we compile reports for the whole business. Here we single out particular department. That's why we say what? Segment. We can decide to say tomorrow now, let's go and check academic department and make decisions there. There's a problem there. It doesn't mean that if academic department is doing something wrong, the whole company is doing something wrong. So we report only on that department. Unlike under financial accounting, we report on the whole. If we say we made 50% profit for the whole, but if we say we made 50% profit share, it means we are looking at one particular department. How much did they make as a profit? Must follow? Remember this? GAAP, IFRS, IAS. There is no accounting framework. It's nothing like, okay, according to this standard, you must do this. No, it's for the management. Even the reports are compiled according to the management what? Priorities. Like they can just, okay, what the report like this. Okay? They don't have to follow what? Any rules. Mandatory in the form of financial statements, meaning required to report by the authorities. It depends. So here you just have to report. You are compelled by rules and the policies to report. Just decide to report for a particular segment. Okay, accounting department. Hey, let's want to report on it. Want to make a decision. So can you see this one? It's voluntarily, but this one is mandatory. So these are the difference between financial accounting and the management accounting. Any questions? Let me know if you need a break. But I'm gonna push this theory and then we can take a break. Now, there are four functions of management, especially if you do business economics and business management. This is not new. It's not only for accounting skills, it's business. Business needs to, the management needs to what? Plan for the whole business. They need to organize. What do they mean by organizing? Meaning, yes, meaning everyone at the end of the day must know what to do. For example, if I'm a lecturer now, I know the activities are grouped together, given to assigned to different people. It's organizing. And after organizing, we lead. That's why we've got supervisors who share, the departmental managers. They need to make sure that they supervise so that at the end of the day we can achieve our common goal. And then controlling, it's not like controlling like in a bad way. Remember, as an individuals, we come from different backgrounds, but now we're working for one company with the same goal. So this leader must be able to control the behavior of all the subordinates towards what? The goal. That's how we use policies and procedures to control the behavior to achieve a goal. And that goal is part of the planning process. Can you see these things are very much important? Yes. That's why where there is no leader, what do you expect? You are leaderless, you don't have you can even say in some time for government. If there is no good leader, like everything is like So a leader must lead by example, must know how to control the behaviors, must plan, hold people accountable, things like that. Okay. Remember when I started here, I said there's a difference between financial accounting and bookkeeping. So this is called accounting cycle. They can ask you to draw this, so you just have to know it. Everything starts from what? Transaction. So a transaction needs to take place. I need to go and buy equipment for gas. I need to go and ask for a loan from the bank. What is that? A transaction. Like you go to the canteen and buy something. What is that? A transaction. You go to the cashier's office and pay for your photocopy. What is that? A transaction. But after the transaction has taken place, there must be a proof that a transaction has taken place. For example, receipts, invoices, check counter, for petty cash, credit note, debit note. Those are called source documents. Proof of transactions. That's why when the auditors come, they ask you, they ask for that file and say, can we have the file? Because they're going to randomly select what? Yes. So they must choose their own source documents. Together. So far, a transaction takes place, and that transaction is summarized on the source document. Okay. No problem, you son. Remember, those source documents come from various transactions. And transactions do not behave the same. Sometimes we buy for cash, sometimes we sell for cash, sometimes we buy on credit, sometimes we sell on credit, sometimes we write off, sometimes we depreciate. Those transactions are not the same. We need specific books for those transactions. Payment for cash, one side. Received cash, one side. Sold on credit, one side. Bought on credit, one side. Those transactions must be recorded in what? In the subsidiary journal. The payments one side, there's a book for it. The credits one side, there's a book for it. Sometimes we call them books of first entry. Sometimes we call them books of prime entry. So it's where we group transactions according to their nature. All the cash receipts, one side. All the cash payments, one side. So those transactions will be recorded in the subsidiary journals. For example, we can talk about the cash book receipts, the cash book payment, the petty cash, creditors journal, debtors journal, petty cash, general journal. We're going to talk about them. Remember, this is just a flow for now. Okay. Now, after grouping those transactions according to their behavior, we now have to open what we call what? General ledger. For example, in one of the books you can find that I bought equipment. It means now I need to open equipment account. Remember when I started here when I was showing you the double edge system? That account is what? Debit and those accounts with debit and credit, they look like a T junction. So those accounts are called what? General ledger accounts. So we open equipment account, bank account, petty cash, cash flow, sales, cost of sales. There are too many. So those accounts are called what? General ledger accounts. After compiling the general ledger accounts, we need to transfer them to what? Trial balance. If I may ask you, do you understand trial balance? A trial balance also has debit and credit. So, but the main function of a trial balance is to check the correctness of the general ledger account. Because sometimes, or in most cases, not all the time, the trial balance won't balance if the general ledger is incorrect. So it means when you are compiling trial balance, your debits must be the same as your credits. If your debits are 5,000, your credits must also be what? 5,000. But if there is something wrong with the general ledger, it means that the debit and the credit won't balance. But that is not the case, always the case. Why? Because sometimes the trial balance balances with the wrong figures. For example, sometimes you forget to record one of the transactions. The trial balance will still balance with the wrong figure. Why? Because you are missing one transaction. Sometimes you make an error somewhere here, and somewhere here you make another error. We call them compensating error. So one error can compensate the other error. Still, the trial balance will what? Will balance. Can you see now? So, but in a nutshell, the trial balance check the correctness of what? Of the general names. After the trial balance, we need to compile what? Financial statements, which is part of accounting 1B. Okay? So financial statements, you can call them what? Financial reports. These are the reports that are going to be used by the management to make what? Decisions. So the financial statements shows us the financial performance of the business and the financial what? Position of the business. For example, we've got a statement called Statement of Profit and Loss and Other Comprehensive Income, also known as income statement. That shows whether we made profit or loss. We also have a statement called the Statement of Financial Position. That statement of financial position is the same as what? The balance sheet. That shows the financial position of the business. Can you see, for us to know those positions, we should have went through the process. And thereafter we can check if we're performing well or not. If we perform better, we will have better financial position. If you don't perform better, you're going to have what? Your poor financial position. So this is called accounting cycle. It is also called accounting flow or accounting process. Again, this flow is like the chapters. It's like the chapters in your book. They follow this. We're gonna have transactions. We're gonna have source documents, subsidiary, general ledger, trial balance. These things are like our syllabus. Okay. Now, if you take this process from transaction to trial balance, this process is called what? Bookkeeping. Can you see that? So you take it from here, transaction, up to trial balance. Up to trial balance. This is what? Bookkeeping. But if you take the whole process, this is what? So meaning under bookkeeping, we don't deal with the financial statement. But the minute we include financial statement, the whole thing is called accounting. So this is the difference between bookkeeping and accounting. Are we together? I think you deserve a break. Or do you think you can continue?
We can go to
A little bit. Okay, yeah, let's just so that we can be able to. We can continue a bit, or we can take a break. Okay. No problem. No? Okay. Because I think it's better for us to finish. If we finish, we go ahead and unlike we wait. That's where we go through. Okay, remember this slide? I did say that we've got 5 groups. I repeated the slide: assets, liabilities, equities, incomes, expenses. Now it's time for us to break down them. But I'm not going to waste time on this because I did explain a lot. But I do have the notes, for example. Now we've got the assets. I just tried to give you some definitions here. What are the assets? Are things you own or resources a business owns. Resource controlled by your business. Can you see that? Resulting from what? Obviously, you must buy it first before it can become your asset. And expected inflow of future economy? Yes, obviously. Why do you buy buildings? It's because you know that they're going to generate more incomes in the future. Can you see that? This is just a definition of what an asset. Okay. Like I said before, the assets have been divided into 2, namely non-current assets, current assets. By the way, what did I say is the meaning of non-current assets? Long term, and then current means short. Okay. Yes. And then here I try to give you examples of what non-current assets. Sometimes land, sometimes we combine land and building, machineries, equipment, motor vehicles, furniture and fittings, investments like fixed deposits or investment in shares. These are just examples, okay? Any question? Examples of the current assets are as follows. As you can see, okay. Bank, but this bank must be favorable. Cash flows. What is cash flows?
Something when you're selling items that cash people you need to change.
Yes, money for small change. Petty cash.
Or buying like other items that you need, like small items.
Small items. Thank you very much. Debtors control. We sell to them on credit. Those who owe us. But we should have sold to them on credit. They are our debtors. Okay. Okay. So when you sell goods on credit, when you sell some of the things on credit, you call them what? Debtors because they owe you. SARS, remember, SARS can owe you, but it must show debit to show that SARS owes you. Because when it's a credit, it means you owe SARS. Trading inventory, same as trading stock, is what we sell in business to make profit. And you need to be careful here because sometimes it's not easy to classify trading inventory. Think about when you sell computers or laptops. The laptop that you use in your office is not what? The laptops which you are selling to the public are what? So you need to check. Okay. You need to know what is the main aim of the business. What are they doing? What are they selling first? Water, electricity deposit. Remember sometimes when you buy a house or maybe renting and then normally they want a deposit. That deposit is refundable. You know that? Yes. So that's why any expense with the deposit is called what? Current asset. It's refundable. It's refundable. Like the rent when you're renting an apartment, normally they say it's 8,000. First month is 16,000. But doesn't mean that you pay 16,000. So the other 8,000 is refundable. That's why a rent deposit is what? It's an asset because it's what? Refundable. It's current asset. Stationery on hand. Stationery is an expense, but on hand, asset. Packaging material is an expense, but on hand is an asset. Can you see most expenses which are on hand, which are the ones that are, we normally call them consumables. They are classified as what? Our assets. Because sometimes you can say, how can I say stationery is an asset because I'm gonna use it? No, this one is all. These are the consumables. Together they are called consumable stores on hand. These two. They are called consumable stores on hand. Accrued income, meaning income still to be received. It's an asset to you, it belongs to you. The income still to be received. Prepaid expense paid in advance. You still have to enjoy the benefit, but you just pay in advance. For example, you pay your rent for the next 6 months. You know that rent still belongs to you because you did not yet enjoy the benefit of staying in that house. You just paid in advance. So it's an asset to you. Okay. Liabilities, like we said, what the business owes is a present obligation, meaning I committed myself. I owe, I gave, past. So obviously for me to owe you, it means something happened before, okay? But this one is going to have outflow of what? Economy, because you're going to pay money out. So that's why we say outflow, unlike what? Assets, we say what? Inflow. Examples again here, mortgage bond, mortgage loan, long-term loans. These are examples of the non-current liabilities. I just missed it here. I should have said non-current here. Okay, non-current liability. I missed it there. Insert for me there. Non-current liability. The current liabilities, opposite of the non-current. Bank overdraft. Creditors, you know them. People, we owe. SARS, as you can see here, is credit now. We owe SARS. Credit card unfavorable. Accrued expenses. This means expense due to be paid. We owe it like telephone to be paid. Payable. Prepaid incomes. Here we received income in advance. We owe that person. Unlike the previous one, it was prepaid expense. We paid someone in advance. It was our asset. But that person owes us. Now this person paid us in advance. We owe him. We cannot use that money till he uses whatever. If it is renting, he must first use the room before he can claim the money as ours. For now, it's what? Current liability. Okay. Equity, like we said, equity capital, like we said, the rights of the shareholders or their claims on the assets. They invested in your business. They've got the rights to the assets. They've got the rights to the dividends at the end of the day. Okay, they invested. The owner's interest in the business. Yes, you invested in your business. You've got the interest in the business with something in mind. You're gonna get something in return. That's why you invested. Okay. Is the residual value, that is when you take your assets and you minus what? You get what? That is account equation we still have to go through it. Okay. So this is our equity. And examples, there are only two. We've got capital is an example of equity. We've got drawings. What is a drawing? For own use. So please write next to this because some people sometimes are confused. Drawings are negative owner's equity, meaning they affect owner's equity negative. You will see by the time when we start recording the account equation, you realize that when we deal with drawings will normally have a negative impact on owner's equity. Yeah, but it's still the owner's equity, but it's a negative. This one is a positive one. Capital is a positive owner's equity. Okay. Now, incomes, as I said, why are we in business? Is because we need incomes. You can't just run a business for fun unless if you are running a charity organization. It's understandable. It's a non-profit organization. But we need to generate income for us to survive. Okay? Inflows benefits in the exchange for providing goods and services to customers. Yes, I sell to you, you give me what? An income in the form of sales. You are renting, I'm renting my apartment out, you give me what? Rent income. You see? They always increase what? Owner's equity. Why do they increase owner's equity? Because they also increase what? Profits. That's why we try to maximize them. Our main aim is to maximize income so that they can have more profit, and profit always increase what? Owner's equity. Okay. Now move on. Examples, too many. Remember, I just put some examples, okay? You can find more, but yeah. Sales, sometimes revenue, services rendered, rent income, commission income, donation received, credit losses. What are the credit losses?
No longer have to pay people.
This is the same as credit loss is bad debts.
Oh.
It's just that the new term that we're using. So when you see the word credit losses, just know that they're referring to bad debts. This means bad debts recovered. Meaning someone who has been written off before came back and said, sorry, can I pay you your money back? Will you say no? No, money is money. You always say, yeah, no problem, you're forgiven. And then you take that money. That becomes an income now. It's not, it's like, it's reversed. It's not bad debt anymore, it's recovered one. Okay. Interest on investment. Sometimes we can invest at a bank, for example, fixed deposit for 6 months. That interest is what? The interest is an income to us. I've got 500,000, I put it in the bank, they give me interest of 60,000. That 60,000 is what? Interest on investment, and I put it under what? Incomes. Interest on bank, savings account. You know, sometimes you need to invest money in your bank account. You can find 5 cents, you know, extra. Ask yourself, where is that money coming from? This one is the interest. Pays returns and creators allowances. Sometimes we buy goods from the creators on credit, and when we return them, it means we owe them less. We call that what? Returns, and sometimes we call it what? This is an income to the business. Remember, this only takes place if we bought goods on credit from our suppliers on credit, and then now we return. We call that creditors allowances. It's an income to us. Okay, the next category, expenses. As I said, there's no business without expenses. I would like to have that business. Okay, when the resources are consumed in order to generate income, it's true. You must use stationery, telephone, things like that. Unfortunately, the outflow of economic benefits from the business because you have to pay for them. These are not favorable, unfavorable, but we cannot avoid them. Okay, and unfortunately, they always what? Decrease ownership. You'll see by the time when you do that calculation, they will decrease ownership. And these are just examples. As you can see, there are a little bit many. Yes, the cost of sales, the purchases, rent expenses, sales returns, telephone expense, advertising. Can you see here? I said credit losses are the same as what? Bad debt, you put the bank charges, settlement discount granted. You will see from now on the settlement discount granted will be absorbed by sales when we record. But I just put it here as one of the expenses, but they affect what? Sales. But I'm going to show you how to affect the entertainment expenses, water, electricity, rates and taxes, food, office, consumable, stationery, packaging. Can you see now? It's not on hand because if it was on hand, current asset. On hand, current asset. Okay. Any questions so far?
No.
Okay.
That's the only thing I need to start.
This is 2 already because we focus on 1 and 2. So I just combine them in one slide, okay? But I just put on top there. What we have been talking about will bring us to this. This is accounting query. I'm telling you, there's no better exam without what? Accounting query. It means assets equal equity plus what? Liabilities. So meaning, for me to acquire my assets, I need equities. Remember, equity is the same as capital. But sometimes capital is not enough to buy assets. I will use liabilities to support my equity so that we can be able to buy what? Assets. For example, if my assets are 50,000 and I only have 20,000 here, I'll make sure that I buy those assets, maybe by negotiating with the supplier and say, can you please let me give you 20,000 and I'll pay you 30,000 using installment. So the 30,000 will be what? A liability. So a combination of the loans and what I had can be able to buy what? My assets. This is a shorter version of what we call balance sheet. Because it shows that your assets are the same as equity plus liabilities. Okay. So on the next, I just try to put the other way around, but normally you find it this way. But now, even though if I can say asset equals to liability plus bonus, it doesn't change anything. It's still what? Accounting. But the most common one is what? This one. You'll find the liability this side and equity that side. Okay. Okay. Yes, for now we have a little bit of understanding of what we did so far. But by the time when we start recording, remember this is all about the theory now. Remember, inventory is the same as stock. By the time when you start recording, you need to be careful when it comes to what? Stock. Because there are two systems of inventory, of recording inventory. The first system is perpetual. The second one is what? Period. So we need to understand what is perpetual and what is what? Period. In general, the word perpetual means constantly happening or ongoing, continuous. Periodic means interval. Certain period can be a month, a year, a day. This is like the way it is. The periodic means an interval or the range in periods. Okay? Now, remember the invention, or you can call it trading invention. You can call it trading stock. When you sell stock, you say you made what? Sales. Did you hear what I said? When you sell stock only, you say you made sales. For example, let's say I'm Pick and Pay and they're selling grocery. Grocery is the trading stock too, Pick and Pay. So by selling trading stock, they say they made what? But if Pick and Pay can decide to sell one of their vehicles, they can't call it what? Sale. Because they're not selling vehicles to make profit. They're just selling because they don't want it anymore. So you only say sales because you are selling the trading stock. You are aiming in the business to sell that particular commodity. But remember, those stock, the stock has been bought at a cost. You can't sell only. You must buy, sell. So when you sell, you must also show the cost of sales, meaning the cost of the stock that I sold. So if I sold for 5,000, I need to check the cost of that stock. The minute you show sales and cost of sales at the same time when the transition happens, what is that system? So meaning under perpetual, they mean when you sell, you must record sales at the same time you must show what? Cost of sales. If within a day I have got 70 sales, it means I will see how many cost of sales? 70 cost of sales. That is what? Does that make sense? But what about the period? Still, when you sell stock, you have got sales. But under periodic system, when you sell, you don't show cost of sales for each and every sale. You wait till the end of the period. It's then that you calculate cost of sales for all the sales at the same time. And here we normally use what? The formula of which I'm going to show you in the later stage. Here we use a formula for all the sales to calculate cost of sales at the end of the period. Here we don't use a formula. We just calculate, show sales and cost of sales for each and every sale. Okay? So I want you to get this theory first. But the most important thing is to know the accounts to be involved. Because by the time when we start recording, we need to know which account to identify. I'm going to show you the differences. At the same time, I'm going to show you the similarities. Because sometimes there are no differences. Everything will be the same for that particular transaction. For example, firstly, as you know, we must first buy stock. I said we buy stock. Remember, inventory sometimes is called stock, sometimes it's called what? Goods, sometimes it's called what? Merchandise. But we are not allowed to open an account called merchandise. No. They must all be called what? Inventory or stock, or trading inventory or trading stock. Here, as you can see, I said we do the same thing. So when we buy inventory under perpetual, one account that we debit, remember the rules are still going to learn more about them. We're going to have trading stock here because we bought what? Stock. But here we don't say we bought trading stock. We say we made what? So you must check the system. So you can be wrong when you answer. So here we call it inventory, trading inventory. Here we call it what? Credit. And again, if we bought for cash, we will create what? Bank. If we bought on credit, we're going to call it what? It doesn't change anything here. It's the same thing. Because the fact is you bought for cash and you bought. The only difference is what do you call inventory under this and what do you call it under this. So here we call it trading inventory, here we call it premises. Can you see the change is only with the inventory related? Sometimes, when when you buy inventory, you incur other costs. Maybe you bought them from Pretoria, you incur transport. You must record that one. You cannot avoid it. Can you see under when you have additional costs? I'm referring to maybe transportation on those goods, and those goods have to be insured. Let's say you bought them from other countries, and we've got the air transport, the freight or freight transport. So those are the additional costs. But when you record them, for example, let's say you get transport cost. You can't record transport cost here. That cost is absorbed by what? Trading inventory. So you just have to say trading inventory instead of what? Transport. But under periodic, you must be specific for that cost. If it's a transport cost, you must write transport here. Can you see the difference? Here, the cost is absorbed by the inventory. Here, you must show me that cost as an account. So there must be an account for what? Railage on premises, for example, or transport on premises. But here you cannot say transport on premises. That transport is added to what? It's like, for example, here, think about a decoder. You buy a decoder, and then they say decoder is 500, installation is 200. So here you just tell me that the decoder is what? It's 700. You add the two. Can you see that? But in this case, you're going to show me the installation cost as an account separate.
So you want to say additional cost, you'll say installation cost.
Yeah. Here I was just trying to be very general. It depends which cost. Sometimes we've got custom duties here. We have got railage on purchases. We've got insurance on purchases. So you're going to be very specific here. So they are all called what? Additional costs, related costs to purchases. Are you okay so far? Can you see again, even if those costs can either be paid in the form of cash or maybe you still owe them, you still have this. Can you see now? It doesn't change. So, as I said, I'm going to show you the similarities and the differences. Now we bought the stock, we have got the stock at our disposal, we are selling stock. When we sell stock, obviously it depends on how did you sell it? You sell it for cash, you debit what? You sell it on credit, that's it. It doesn't change. The way you sold it doesn't change. Remember I said when you sell stock, you say you made what? Even here you made what? Sales. Can you see that? But remember I said under perpetual, when you show sales, you must also show what? Cost of sales. Normally we call this A part, this is the B part. The B part is where you show the cost of sales. Okay. This cost of sales is the cost of sales of what? Inventory. Meaning cost of sales always go with trading inventory. Cost of sales always go with, because when you say cost of sales, cost of what? Inventory. So can you see when you sell stock under perpetual, you must always have 4 accounts. And you must know how to pay them. These always go together here. These two. And these ones always go to, you cannot mix them. You must first deal with the sales and show me how did you sell. Then after you show me the cost of sales and show me that it's the cost of sales of what? Of trading inventory. Because of the perpetual nature. You show sales and cost of sales. Can you see here there's nothing? Because we don't show cost of sales for every sale. We can only wait till the end of what? To calculate the cost of sales for all the sales at the same time. So this is very much important. Especially by the time when we start recording, we are going to refer back to this. This slide, I expect this slide. Okay? So this is very much important. And this is the end of learning unit number 2. Okay? So after break, we can just take some few examples just to check if we understand, because this is what we were supposed to cover for today, but we're going to take some exercise just to try to check if we understand. Not a lot. I know I don't believe in overdose. It's very dangerous. Sometimes we just want to finish and then but as long as so far you understand. Okay. I think we can take a break and thereafter we can continue. Okay.